As we are discussing two-point analysis, in two-point analysis we came across certain ratios. The first one is a net margin ratio, second one is the asset turnover ratio, and the third one is a leverage ratio. So I thought of explaining each of the ratios in a bit detailed manner so that we would be able to understand a DuPont properly. So let's focus on the first ratio. It's called net margin ratio. Net margin ratio is primarily, you can see in the slide that it's net income divided by the sales. I took net, which means it's net of returns. Obviously it's net of returns. So what does it says? What does net margin ratio actually says? For example, if the entity is able to make a sale of rupees 100 and the net margin ratio is 10%, which means the net margin is 10, which specifies that for every for every 100 rupees of sale, the entity is able to generate 10 rupees for the shareholders of the company after deducting all the expenses. The net margin generally comes from like sales minus cost of goods sold. You would be able to get the gross profit. Then you will deduct all the operating expenses. You will get the operating profit, EBIT. Then after that you deduct the interest expenses and deduct the tax. You will get the PAT. So it's like if the net margin is 10%, suppose the entity is able to make a sale of 100, then the PAT is 10%. I'm assuming there is no preference dividend and all, so 10%. So this is what net margin ratio says. For every 100 rupees of sale, what's in rupee term that the entity is able to generate for the equity shareholders. Now the second one is the asset turnover ratio. It's a part of the efficiency ratio. It specifies how efficiently we are able to utilize our assets. Suppose the efficiency ratio comes to 0.9 or 90%, which means that for every 1 rupee of investment in the assets of the organization, the entity is able to generate 90 paise of sales. So the 90% is your asset turnover ratio, which means for every rupee of investment into the assets of the organization, so what is the entity is able to generate from those investments. And the third one is the leverage ratio. So what do you mean by leverage ratio? Leverage is, first of all, let's understand what leverage means. Leverage is something which amplifies the financial consequences. For example, I'll give you two scenarios to understand this leverage. There's operating leverage and financial leverage. I'm not going to that detail. It's a kind of financial leverage, because using debt is a part of the financial leverage, and using fixed cost into the operations of the organizations make the break even more riskier. It's a part of the business. It's a part of the operating leverage. So we are not going that detail. So think about two examples. The first one, suppose the leverage ratio is 2 and another one, the leverage ratio is 1. Suppose the entity is able to generate 10% net margin over the period of time. Then in such a case, if the leverage ratio is 2, the profits or the return on equity would be 20%, because leverage is something which amplifies the financial consequences. As the leverage ratio here is 2, which means all the financial consequences will be duplicated, or the return on equity would be 20%. And in the other case, it is the same as 10. But for example, if things goes wrong and the return goes minus 10%, the net margin goes down minus 10%, then in such a case the return on equity will be minus 20%. Anything happens, any financial consequences, the leverage ratio magnifies. So the leverage ratio is do not compare this with debt and equity. It's a kind of debt and equity ratio, but debt and equity has something else to say, and this has something else to say. Here the numerator is the total assets, but in debt and equity ratio the numerator is the total debt. So and we take only interest bearing loans as a part of the equities, as a part of the debt. So that's a different story. Here I want to explain you the things like the total assets. What do you mean by total assets? It's a total asset that we have invested into the business. So if this ratio is high, which means the financial consequence, whatever the entity is going to get, is going to be multiplied at a very significant rate. So this is what leverage ratio means.